when we start segment 5, we want to look at how Europe ended and how we ended the European section, because it's important to look at the Chinese side of imports, exports, because exports for China remains the only real bright spot, but imports continue to struggle and continue to remain low on, and again, to export, you have to import raw materials and semi-finished goods. But this is looking more at finished goods, because China, and again, this is a little tongue in cheek, but most people of Chinese wealth also don't buy made in China. They buy European products. They buy European cars. So the fact that the social financing side remains so low in China, it just points to, and again, as we talked about repeatedly, the pressure on retail sales, that's going to impact trade with Europe. And then that's where we see this perpetual kind of slowdown when we look at European growth and what we expect to see from China. And we don't see really anything coming from China to adjust this, especially on the retail sales side. So now when we look at the view of China industrial production, right in line with pre-COVID levels, they're right kind of back to where they quote unquote should be. But the retail sales, the China real retail sales, is where we have this huge disconnect, where it's not something. It started back in 2018 when you look at kind of the sideways move, and then before we really had the drop in 2020, you saw this kind of breakdown in 2019, and that was when we really started to get concerned about the overall economy, the health of things going forward. Then you had this recovery, but what did you have? You had a huge pent-up demand from 2020 lockdowns. You had a significant amount of easing that came through on the fiscal side. You had tax cuts, you had incentives, you had the movement of dual circulation strategy. Then you had you had the shift to have common prosperity. And they still can't get things back. And it's 10.7% off of trend. And that's a big problem when you think about how China's trying to transition themselves into a consumer economy. And without that, you're really not going to see the same type of growth and the same type of strength as companies continue to nearshore, diversify supply chains, and it is going to put pressure on not only industrial production side, but also on that underlying export. And that's when you start looking at the divide. So the spread between U.S. and Chinese CPI has rolled over slightly, but remains near widest in more than 2 decades, as inflation remains high in the U.S. and relatively muted in China, because they're trying to protect local price. And the PPIs have exploded higher, but export prices, they're trying to be competitive, but there's only so much they can do. And without having some of this price pass on, which is why some will say, oh, well, China can ease, it's like, but they're already easing by what they're trying to accomplish, and if you think about what they did during the trade war, and which is still really kind of ongoing, really, they've tried to ease. They have VAT tax forgiveness. They had tax cuts. They had other types of pauses. So this has helped. This is already stimulus that never went away. So it's really difficult, again, speaking back to the law of diminishing returns, of how much can they really lever on and slap on more, given that they never really took much away. And that's, I think, some of the underlying problems that we're seeing on the path of China's PBOC policy. Now, we've said for a long time now, we expected credit impulses to bottom. They have firmly bottomed, but there's not going to be this huge surge back up. It's going to be more of that bump along the bottom, because there's still this pressure. There's still these issues that remain, and they've been trying to hide this inflation, these price increases, which has been forcing the companies to take them. And that's, I think, some of the bigger pressure points. Now, China's gold imports are rebounding. I don't think that's a surprise. Gold prices are relatively cheap in comparison to where they should be. And they're also trying to find ways to protect against inflation. And gold remains one of those stalwarts to try to protect against inflation, especially when you consider the amount of offshore defaults in Chinese corporate bonds this year. So offshore defaults of Chinese corporate bonds have surged to a record in December, and January actually has more coming due. So if you think about purchases of dollars, increase in dollar holdings, increase in gold, this is a way to help offset some of these fears. Chinese firms have defaulted on a record $3.8 billion in offshore bonds so far this month. The previous monthly high was January, when Chinese borrowers failed to repay $2.7 billion. And a month that saw Evergrande, CAISA officially labeled defaulters. December has seen a precarious rally in Chinese junk bonds, threatened by heightened anxiety over the financial health of other companies such as Simoa, Guangzhou, and as liquidity crisis sparked a government crackdown. Now, more risk is just in the wings when you think about January. So Chinese developers need to repay or refinance about $6 billion worth of bonds. Next month, Guangzhou RNF is asking holders of $725 million note maturing January 13th to extend the due date by 6 months, and is offering to buy back some of the debt at a discount. If the proposals aren't backed, the company said it might not be able to fully repay the notes. So you're already starting out on a very weak footing as we head into January. So what are some of the things that have done? So when we look at the China 1-year prime rate, China cut benchmark loan rate for the first time in 2 years amid some of this mounting pressure. The 1-year loan prime rate was cut from 3.85% to 3.85% to 3.8%. The 5-year LPR, which is the reference for mortgages, remained unchanged. So you're getting a little bit of something, but you're not getting a huge mix. And if you look from when they cut right after COVID really hit for them in April of 2020, they never raised it. So this is what we're talking about. They never took away the stimulus that we saw that really kicked off in 2019, as you see the step down in 2019. We never got back. So the law of diminishing returns is there. The fact that they've never really tightened to ease. So the impacts this is going to have will be mitigated and muted. And then when you think about their exposures, or the U.S. exposure to China, especially when you think about green and well, let's look at market share by country for each step in the solar supply chain. Polysilica, 75% China. Wafers, almost 95% in China. Cells, almost 60%, 70% in China. Modules, almost 60% in China. So when you look at how they've continued to move themselves and take control of this, when we look at the green movement and the green push, it's like natural stimulus for China. So again, we have to think about how much of this is going to be onshored, how much of it is going to be nearshored, and how are ways to help U.S. companies really benefit from some of the stimulus and spending, and not just China. So when we look at Chinese foreign direct investment, you can see that things still remain elevated and right around 2020 levels, but on a cumulative basis, it still remains high. And this is something that we think will start to slow as we go into next year, just given where some of the friction points are and how CapEx shifts happen outside of China. Now, taking that to the next level, the Chinese economy remains very weak. If historical correlations hold, the current consensus around commodity supercycle and inflation expectations might not transpire, because construction activity index in China remains at an all-time low and continues to have this pressure point, which will cap really industrial metals. It's not that there's enough supply disruption, there's enough demand in other places that you can see some of these metals find some sort of support, especially after the Chilean election that is going to see a government control of some of these copper mines, and even a reduction or a pause in some of the new licenses that were issued, which is going to hurt capacity and hurt supply. But we're just not seeing that much demand from China either because of all the pressure points across the economy we've discussed. And that's when you start looking at China fixed asset investments. Number of monthly new projects approved is at a record low. So there's also, even though there's talk of, oh, well, we want to invest in infrastructure, well, we're not seeing it, and we're seeing some of it slow, and a lot of it is bottomed, and a lot of people are saying, oh, there's a turning point, it's bottomed. Well, bottoming doesn't mean it's going to rally. It just means it's going to stop going down. There's still a move of draining some of the liquidity. There's still a move of trying to adjust some of this and create a different type of pivot for how the economy will look going forward. Now, the sharp decline in property was arrested or at least stopped in November, which is what we've been discussing, where property sales, they're still negative, but construction starts, property sales, but steel output, real estate, they're all starting to, again, getting to that floor. But we don't think that we're going to see this huge spike. It's just, again, going that sideways movement. And then the real estate investment and residential gross floor area starts continues to be depressed. New home sales, new home sold, has flatlined, and this is what we've been discussing in terms of some of this bottoming out. Now, rounding things out with South Korea, PPI came in at 9.6%. The prior was expected at 8.9%. Imports remain elevated. Last month, they were at 41.9%. They came in at 42.1%. Exports slowed a bit, but again, imports being elevated, the fact that South Korea is a major exporting nation, it does bode well for exports remaining strong in both January and February. So that's what we have for you to round out the year on the economy side. If you have any questions, again, you know where to find us in the comment section on Twitter. Thank you for staying with us. We appreciate it. And now tomorrow, or at least Thursday, we're going to have our Primary Vision frac spread count show, and that will be the last show of the year. So we appreciate your support, and please like, share, subscribe, as we always appreciate. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.